Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are analyzing an article titled 7 Stocks About to Soar as Fed Rate Hikes Pause. So essentially, we're going to be talking about the best stocks to buy right now, so regardless if the Federal Reserve increases rate hikes later to get inflation under control, or if the pause is extended or even ends, these companies are going to surge in their overall share price. Investors should be worried about what the Federal Reserve plans to do to further get inflation under control, and that could be more rate hikes in the future. But regardless on whether or not the rate hikes will stop or if they continue, these are going to be some of the best companies that could have a very good comeback once this blows over. So let's talk about how we can best position ourselves. I will be adding my personal opinion on these companies, if I own them or not, and what I think about them overall. So let's start off with one of my favorite companies, which is JP Morgan Chase, ticker symbol JPM. JP Morgan is one of the largest banks in the United States, and many investors are somewhat skeptical about investing into financial or bank stocks right now, considering the collapse of Silicon Valley Bank and many other banks. However, I think this is the best time to buy financial stocks because we're going to get them at very cheap prices. On top of that, if the Federal Reserve continues to rate hike, or if they stop, we have a very increased likelihood of this stock increasing in their overall share price. JP Morgan is one of the largest and stable banks in the United States economy, so therefore it's reasonable to anticipate that ticker symbol JPM will increase and appreciate from here on out. On top of that, not only are we going to get great growth for this company, but they also offer a dividend yield of 3.07, which is quite high, especially for a financial stock. Up next, we have a General Dynamics, ticker symbol GD, and this is a defensive stock which focuses on the defensive industry, and there has been significant tailwinds for this overall space. This company provides stable earnings and income, and even though the Federal Reserve is increasing interest rates to get inflation under control, this company will not really be affected because the demand for military equipment to fight wars seems to offset any inflation. Essentially, inflation doesn't really affect these types of products, especially as the war between Russia and Ukraine continues to heat up and it's not anticipated to end anytime soon. General Dynamics specifically is one of the most prominent U.S. defense firms, and they have already signed a contract to supply Ukraine with tanks. And even if the United States economy continues to worsen, it's not likely that the government will stop buying military equipment from government contractors. Therefore, this company is extremely stable, and as the macroeconomic environment globally gets worse, other military conflicts could break out, thus increasing the overall share price of defensive contractors such as General Dynamics. Not only does this company have a great growth trajectory, but they also offer investors a 2.21 dividend yield, which is very good, specifically regarding a company that is not going to be tossed and turned by rising inflation or increasing interest rates. Up next, we have another favorite of mine because so far I do own JP Morgan, General Dynamics, and of course PepsiCo, ticker symbol PEP. And there is lots of reasons to believe why 2023 should be equally as strong. Not only has this company given investors phenomenal growth over the last 5 years, but they also offer investors a 2.52 dividend yield. PepsiCo overall is an extremely strong company to where they brought in $86.39 billion worth of sales in 2022, which equates to a 9% increase on a year-over-year basis. On top of that, their dividends were increased by around 6%, so investors are getting growth hand over fist for this company, not only from the company itself growing and their share price moving upwards, but also the company is growing their overall dividend, giving investors a fantastic passive income. PepsiCo not only offers their consumers beverages, but also snacks such as Doritos, Cheetos, and Lay's chips, which are all selling very well. Therefore, over the long term, this company is anticipated to continue their amazing growth, and that's why it's personally in my portfolio. Now we enter our first stock that I'm not very excited about, and this is the first company on the list which I don't hold in my personal portfolio, but that doesn't mean that it's necessarily bad for you. Altria, ticker symbol MO, is a tobacco company, and investors really like this company because of their very high dividend. They offer a dividend yield of 8.4% to investors right now, giving people a very high dividend yield and very impressive passive income. However, I think the more significant question is, where is this company headed over the long term, because smoking actually continues to decline and not increase as time goes on, making this company not a favorable long-term investment. However, if you like this company just for the passive income, then feel free to do so, but it doesn't align with my personal portfolio and my investing strategy. I don't necessarily want to be overexposed to companies that aren't anticipated to grow over the long term. Even though it does give you a high dividend, I don't think it's the best company to hold in your portfolio if your portfolio is a hybrid portfolio like mine, which focuses more on long-term growth and a little bit of passive income along the way, because during times of stock market uncertainty, dividends do come in handy a lot, and I always reinvest my dividends into the companies which give them to me. However, for this particular company, it doesn't align with my personal portfolio or my investing strategy. But if you are a big dividend investor, you probably already have this company, or if you take a hybrid approach that mainly focuses on growth such as myself, I wouldn't recommend this stock. Up next, we have Kellogg, ticker symbol K, and this company is anticipated to benefit just like PepsiCo is. The strong trend in snacking and snack-like products has flabbergasted Wall Street, especially in terms of their overall revenue expectations for Kellogg. This company beat expectations by around $130 million in the most recent quarter, which was a huge beat. They also anticipate that this trend will continue well into 2023, just like what we were talking about with Pepsi, making this company extremely fundamentally strong, even though I personally like Pepsi better. Kellogg's is also a stock for investors who want a strong dividend yield, considering that they currently are offering their investors a 3.5% dividend yield based off of the current share price. Overall, I don't really have much of an opinion on this company, but I do not own it in my personal portfolio. Kellogg may be good for some investors, but not others, and for me, I just think that there are other companies that deserve my hard-earned capital instead of investing into this particular company. So with that being said, I don't own Kellogg, but I do think it could find its way into certain portfolios depending on your overall strategy. Up next, we have another company that I personally don't own, but I do think they are a good company, and I'll explain why I personally don't own them. We're going to talk about ticker symbol BP, also known as British Petroleum, and this stock is really trying to pivot more toward green energy. A lot of investors like this company because they offer their investors a dividend yield of 3.76, which is very good. However, due to high oil prices and many fossil fuel companies transitioning more to green energy products, I really don't know what's going to happen with fossil fuel companies such as British Petroleum, ticker symbol BP. European energy firms, including London-based BP, have been more vocal about their low-carbon energy production than their United States-based counterparts and peers. BP specifically made around $27.7 billion worth of profit in 2022, which is behind ExxonMobil as well as Chevron, because these types of companies are more fossil fuel based. While on the other hand, BP is making investments into the more green energy type of space, meaning that in the short term, they are not focusing on their fossil fuel segment. The reason I personally don't own this company, which is the same reason I don't own ExxonMobil or Chevron, is because I don't know what's going to become of fossil fuels in the future. I would much rather invest into other companies that are more stable and solidified in their respected space instead of fossil fuel energy companies. I don't mind investing into green energy companies either because that is the future, but honestly, these companies are going to have to pivot on how they make money, especially as electric vehicles start to roll out onto the market. More green energy companies invent technology to get and power various facilities and infrastructure apart from fossil fuels like oil. So because of the ambiguity of the future of these fossil fuel companies, I don't feel comfortable investing into these companies, but overall, fundamentally, yes, all three of these companies, BP, ExxonMobil, and Chevron, are all very accomplished companies. I just don't feel comfortable investing into them because I think the future is going to leave them in the dust if they don't pivot quick enough. I would much rather wait for them to pivot and prove themselves in the green energy industry rather than invest now prematurely, but I would leave that choice up to you. Last but not least, we have Pfizer, which is another company that I do not feel comfortable investing into because as time goes on, their revenues will decrease, and I'll tell you why. Pfizer, ticker symbol PFE, is a company that's most notably known for their vaccines. However, investors haven't been excited about this company's lessening overall revenues, and the reason why that is because as more people take vaccines, they no longer generate revenue for this company. Investors aren't excited about this one bit, and as time progresses, we can see that their overall revenue growth will lower, at least in this particular segment. Even though Pfizer is anticipated to bring in revenues of around $61.1 billion for the year of 2023, and they do offer a strong dividend coming in at 3.95, overall, this company's long-term trajectory is too uncertain for my taste. There are other biotechnology companies and healthcare companies that are much better than Pfizer in my opinion. I'm thinking of companies like United Health, Eli Lilly, and even Johnson & Johnson. Those companies not only have a better growth trajectory in my personal opinion, but they're just fundamentally stronger companies than Pfizer is. All in all, I would say that the last few companies we looked at are not very impressive according to my own analysis. However, JP Morgan, General Dynamics, and PepsiCo are the clear winners. And those are the companies I'm going to be buying over the next few months because I believe the recent trends and long-term trends support this overall analysis. I would love to hear your thoughts down below about JP Morgan Chase, General Dynamics, PepsiCo, Altria, Kellogg, BP Inc., and Pfizer. Which of these companies do you own, and what do you think of this analysis? Remember to go and annihilate that like button right now for more videos just like this one, and I will see you in the next YT video.